Introduction. What are financial statements? Financial statements provide financial information about the performance of a business entity. There are three main financial statements. 1. Balance sheets. 2. Profit and loss statements. And 3. Cash flow statements. Companies prepare financial statements periodically. There are annual financial statements and quarterly financial statements. Some companies even prepare financial statements once a quarter for intermanagerial and financial reasons. The balance sheet. The balance sheet presents the company's financial situation for a specific day, usually the last day of the fiscal year. If we take a look at a balance sheet, we will see it is composed of three parts. One, assets. Examples include cash, machines, and real estate. 2. Liabilities. A company's long-term loans and suppliers are examples of liabilities. 3. Equity. The equity is the difference between assets and liabilities. It also reflects the company's debt to its owners. The profit and loss statement. The profit and loss statement presents the income and expenditures for a given period, such as a year or a quarter. If we take a look at profit and loss statements, we will see it starts with revenues, such as sales, and continues with a detailed list of costs and expenditures, such as cost of sales and marketing expenditures. The bottom line in this statement will be the net profit. Wear and tear. Investment assets are known for their wear over the years. But how should a company measure the decrease in an asset's value? The most popular method is called the straight line method. This method relies on two basic assumptions. Each asset has a known period of life to live. Wear is gradual, therefore, the reduction is the same sum each year. Virtual depreciation. When companies list wear and tear in the financial statement, they actually list it as an expenditure, making it look like they bought the asset in equal payments over several years. Listing these expenditures doesn't reflect an actual money flow, and this is why we call it virtual depreciation. The cash flow statement. The cash flow statement presents the aggregate movements of cash in a company for a given date. It can explain the difference between the cash that was presented between two fiscal dates and give information about the company's liquidity. The cash flow statement structure. The cash flow statement describes cash movement in three levels of activity. 1. Current activity. This includes cash movement from a company's regular activity, such as sales. 2. Investment activity. This includes, for example, purchases of fixed assets. 3. Financing activity. This includes taking out bank loans or issuing a share capital. The effect of credit to customers and credit from suppliers on cash flow. Each dollar in the customer's item in the balance sheet is a dollar of sales that the company has not yet been paid. It increases the net profit in the profit and loss statement by $1 beyond the cash accumulated by the company during the period. On the other hand, every $1 in the supplier's item in the balance sheet represents $1 in expenditures that the company has not yet paid and increases the company's cash by $1 in relation to the net profit. The effect of depreciation expenditures on cash flow. When a company purchases an asset, cash actually leaves the company. Depreciation expenditures decrease the company's profit over the years, although no cash is actually paid for them. Statement of changes in equity. Another sub-report financial statement is the statement of changes in equity. This financial statement presents the causes of changes in the company's equity during a given period and includes three main parts. Equity at the beginning of the period, changes in equity during the period, equity at the end of the period. Changes in equity can occur because of distribution of dividends or because of an accumulated profit or loss. Financial statements adjusted for inflation. Inflation reflects a continuous process of rising prices over a period of years. Financial statements adjusted for inflation reflect the company's monetary activity. Thanks for watching. We wish you a successful learning experience.